And so I think there's certainly an issue there to be aware of as we move into this cycle. Investment activity in the suburban markets has reduced after initial splurge of activity in about 2007, and the private investor market is obviously still very strong, with about 50% of activity last year between syndicates and private investors. But I think this is a market too that now deserves more attention given the tightness in vacancy and moving into the next cycle with a bit of development activity. And so I think you should start to see the demand for suburban office increase. The question again is whether or not there'll be enough stock to start to see a higher level of trading activity in the year ahead. Interestingly, in suburban markets, we really have seen pretty flat rental environment to date. There really hasn't been, despite a generally lower level of vacancy over the last couple of years, we haven't really seen rents move up that much. The only market where we've seen a bit of a step change, interestingly, is Southbank, where the effect of new building quality has really pushed rents up to a whole new level. And we think that similar impact, that similar process, is now available to occur in other suburban markets, where there's been a lack of new building for a number of years, and perhaps some new stock coming into the market now at a new higher economic rent might be the impetus to rise rents, to increase rents to a new level in a number of suburban markets. We know that values haven't really increased as a result, very much so far in this cycle in the suburban office areas. So the creation of value in suburban office has really not been so much on the rental side in this cycle so far, but really more on a slight compression of yield. So really the market is set to move up if those new buildings can achieve those higher rentals in the short term. So overall in the suburban markets, I think it's really characterised by quite a critically low level of construction activity, really causing the market now just to tighten up. Tenant demand, we think, may spread from the CBD and provide that opportunity that the market needs in the way of pre-leasing and getting new development underway. Vacancy is low now, and just low as probably it will go in the various suburban submarkets, except of course for St Kilda Road, where it seems to take a lot longer to bring vacancy down. The rent growth opportunity does exist if that new stock can come in at a higher economic rent, and the issue perhaps in some ways that's holding the city fringe market back at least is the competition between residential, which has been quite intense over the last few years as the population growth continues to run at a higher level. That may come back a little as population growth rates also come back a little in the short term. But there are two professionals out there in the suburbs wearing out their shoe leather and their tyres every day of the week. That's Andrew Dawkins and Richard Hyde. I'd like to invite them to the stage and tell us how they're seeing the market out in the suburbs at the moment. Please join me in welcoming Andrew and Richard. Andrew. Okay, Richard,
yep.
Welcome.
Thank you.
Okay, well, Richard, we might start with you. This is your first market outlook, but you're a man with great experience in the outer suburban office sector. Give us sort of an overview of how the suburban office market has been faring recently, the sort of position it's in, and how you see the year ahead.
Thanks, Kevin, and good morning all. You called me a veteran the other day, Kevin, so I appreciate you not calling me a veteran today. I think there's two major points that we see coming out of 2011. The first being what is most likely going to be the re-emergence of the pre-lease market. We haven't seen a pre-commitment for probably about 4 years now since Salter pre-let about 7,000 square metres out at Nexus Corporate Park to IMA. So it's a long time between drinks. I did forecast halfway through last year in a national podcast of the Victorian office team that there'd be 5 pre-commitments possibly within the next 2 years. So I know my scoreboard is currently a donut, but I would have thought by the end of this year there may be 3, possibly even 4 pre-commitments. On the other side of things, as you've touched on, Kevin, the market is certainly tightening, not just in the inner fringe, but also in the southeastern market. Whether you're a tenant looking for 400 square metres or 4,000 square metres, it's no longer a smorgasbord of opportunities to inspect for tenants. In fact, I think tenants are going to get a rude shock when they do look at what is available for them if they do have to make a move. They're the two key points, Kevin.
What about the city fringe? Can you perhaps give us an insight into the city fringe market? There were a small number of larger buildings that influenced the vacancy rates initially in the city fringe markets. They seem to have been absorbed now. What's the situation in the city fringe now?
Well, we certainly went from an oversupply with the construction phase of a number of properties, Botanica in Burnley, Johnson Street, Abbotsford, Elizabeth Street in Richmond, and also Punt Road in Richmond. Very much an oversupply to now only one of those buildings, Punt Road, Richmond, currently available for lease. And market sources tell us that that's close to being 75% let. So again, very much a tightening of the inner fringe market. And if we switch across to St Kilda Road, whilst the stats that we've all seen this morning don't show a pretty picture for St Kilda Road, Grant Tinker, my Associate Director for St Kilda Road Leasing, tells me that there's been a fair amount of absorption from late last year to early this year. So as we've heard this morning, I concur that we'll see that backfill space from tenants moving out of St Kilda Road into the Docklands areas will be backfilled with smaller companies taking that space.
Okay, Andrew, let's talk for a moment about the investment market in the suburban office areas. We've seen that investment activity dropping in the last few years. What's in store for 2011? Who do you think the sellers are likely to be and the buyers in the market in the year ahead?
Yeah, we certainly didn't see a great deal of turnover last year, 2010, and I think it's going to be the same story again in 2011. I think there's still some residual selling down from the funds. Again, we've talked previously merger activity and the like. There's some gearing that has to be sorted out with some, and for others it's just moving out of non-core assets. So I think that's the source of some of the stock this year. But I also think that there's been a lot of impatient money sitting on the sidelines wanting to get out of investments. I'm talking private money, wanting to go into other areas of activity, be it their own businesses. But they haven't been able to trade just due to the volatile market conditions. And I think the big difference this year is people are seeing stability return to the market, and that'll allow some people to place their assets onto the market to trade.
Okay. Do you think there'll be much distress in the market this year? I mentioned earlier that financiers were probably harder in the suburbs for owners and developments than in the CBD. Do you think there'll be much distress left in the market this year?
Yeah, there's certainly some stress in the marketplace, and there's a couple of significant assets that'll hit the market this year in that boat. But typically, you'll find the investment market has got enough interest coverage to satisfy the banks, and they'll probably not push too hard on those assets, but probably focus more in on development sites where there's little or no interest coverage, and there'll be a lot of stress in that part of the market, I would suggest, this year.
Okay, so what about existing owners? I showed some of the charts earlier about a pretty flat sort of rental environment. How do existing owners grow their returns in suburban markets?
Yeah, I think we had some yield compression come through last year, but as I said before, conditions have stabilised on that front, and the growth going forward is going to be rental growth, and that's what you have to focus on now, be it market reviews or lease expiries, to capture that growth. That in turn down the track as a second phase of growth is going to compress yields, but I think that's stage two. Stage one right in front of us now is the rental growth potential.
Okay, so I talked about development activity and whether it could be the impetus to lift rents, but one of the issues, of course, in the last few years has been competition from residential sites. Do you think there'll be ongoing competition during 2011 for sites?
There'll be competition, but really it's a race that's always won by residential, and the story's compelling when you're selling residential product at $10,000 to $12,000 a metre and you're selling office stock at $5,000 to $6,000 a metre. Residential, where the zoning permits, is going to win out every time, and I think there's a bit left in that race with the residential infill market, apartment market. Where commercial will come into its own is in a Business 3 zoning, for example, which precludes residential. And I think this year, as we've already stated, we are on the cusp. We're not quite there, but we are on the cusp of the pre-commitment market occurring.